After a difficult week, a fair question is, what are the charts telling us now? This is the title slide from last week's video. Did the charts help us? Yes, they did. They told us prior to this difficult week that the correction odds were increasing. We have a lot to cover, so let's go right to the charts. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In the present day, we're somewhere in here now. If the correction lasts longer, your game plan is to cut risk here and then re-enter at a better cost basis here. We're at a similar point here. If we corrected for several months, the game plan is we've already cut risk further, be patient, and get a better entry point and wait for the next rally. Why do we do this? Corrections can last a long time and be severe. We have an article. You can find it by Googling this title. Here's a handful of corrections that took place between 1982 and 2014. The average loss on the S&P 500 was 19.5%, and the average duration was a whopping 114 calendar days. This is a weekly chart of the Nysc Composite Stock Index. It's a broader index than the S&P 500, meaning it contains more stocks. We'll explain these concepts one time. So I apologize to regular viewers, but it will help new viewers, and we'll use them throughout the video. These are moving averages here. This is price. A full bore bullish look is when price is above blue and red. Blue is above red, and the slopes of both are up. This tells us that the probability of good things happening has increased. It also helps us discern between volatility to ignore, volatility to ignore, volatility to ignore, and now this week, volatility to respect. We have now moved to a full bore bearish look. Price is below both moving averages, blue is below red, and the slopes of both are down. What does this tell us? It tells us that the odds of bad things happening have increased. This is a much lower probability market than this here. What it doesn't tell us is how long this will last. So we will go into next week with an open mind. How do we use this? The more this can morph into something that looks like this, the easier it is to scale back in with our cash. There are 3 steps for a trend change, and I'll show you an article details what these 3 steps are. Weekly bullish trend. Step 1, we broke the trend line. Step 2, this is a lower high relative to this high, and this week we completed step 3 by making a lower low. This low here is lower than this low here. This is what an uptrend looks like. This is what a downtrend looks like. To find more detail about the 3 steps required for a trend change, you can Google Ccm Market, my last name Shavako, and then trends, or just Google this title and Ccm Market, and you should be able to find it. It has more charts and more examples. Why have we been reducing risk over the past week? We started a week ago today. On Friday, cut risk twice again during the difficult week. Why are we doing that? This has moved. This is the S&P 500 Index weekly. We just talked about it. It has moved from a full bore bullish look where the odds are in our favor to a full bore bearish look. Stocks, growth-oriented stocks relative to defensive-oriented bonds. Bullish posture in favor of stocks from a probability perspective has flipped over to a full-bore bearish look in favor of bonds over stocks. Is everything horrible? No, there's a lot of longer-term things that are still bullish. This hasn't flipped over to a full bore bearish look yet. The triple Qs, it's still holding on. Blue is above red. The slopes are down, but we don't have the full bore look like this. The Dow is a good example of the concept of we don't know how long this full bore bearish look will last. It could last several months, 100 plus calendar days, or it could be very short-lived like this full bore bearish look. But you can see how we use it. Odds against us, odds in our favor, and then good things happened. Credit, and we understand there's a mismatch here with duration. Full bore bearish look. This is a risk off look as of the close on Friday, August 1st. Would I rather own stocks? Would I rather own TLT long-term treasuries? It too has flipped over to a full bore bullish look in favor of treasuries and a full bore bearish look against stocks relative to treasuries, telling us that the probability of bad things happening in this ratio is higher here than it was here. This is a chart tracked by the Ccm Market Model. This is weekly small caps here, IWM in isolation. The purpose of the exercise, regular viewers have seen this before. This is the S&P 500 up here in black for comparison purposes only. This is IWM or small caps. You can see here, traded sideways for 5 months, indecisiveness, helping foreshadow this waterfall decline in the S&P 500. Traded sideways for 3 months, helped foreshadow this waterfall decline in the S&P 500. We have now been trading sideways, point to point, for 9 months. Does it tell us that we're going to roll over in the stock market and small caps? No, it doesn't tell us that. It tells us the probability of rolling over is higher now than it was here. We won't spend a lot of time here. We want to make one point. It just gives you a better perspective. Full bore bearish look observable here. Bad things happen for several weeks in the weekly S&P 500. Full bore bearish look observable before this decline. We now have a full bore bearish look. As long as it stays that way, the CCM market model will check bearish boxes. The market model is a lot more than momentum indicators or just Williams percent R. We just use this a lot because it's good to illustrate concepts that are used in the broader model. Regular viewers know S&P 500 weekly, when momentum drops out of overbought territory here, it's observable, the probability of bad things happening increases. Momentum drops out on a closing basis, the probability of bad things happening increases. Remember, this is several weeks. We did drop out. Last week we closed above. This week we closed below. Does that mean we're going to crash next week or correct? No. It just tells us that the probability of bad things happening is higher now than it was last week. And in our book, that means we don't want to take as much risk as we were willing to take until this clears up. Everything that we just said about the S&P 500 weekly chart applies to the Nasdaq. We just want to keep our regular viewers up to date. We did close out of overbought territory. That's an observable change. Last week we were in here. Now we're down here. This is a daily chart of the S&P 500. Quickly, we had potential support here and here. Potential support, potential support. We've broken support, and we're below the 50-day moving average. Something that is relatively good or could be good on a short-term basis is that we did close in the middle of the range, which increases the probability of at least a short-term bounce on Monday. However, experience tells us we do not like to make decisions based upon a single candlestick, especially a candlestick on a daily chart, but this is noteworthy. Where are we now technically? We're in about roughly a 50-50 market. Roughly 50% of the questions are coming back with positive answers, 50% are coming back with negative answers. It's a profile that might be similar to this here, telling you that the probability of something happening over a course of days or weeks is higher, but it always doesn't have to happen that way. Observable change, close below the 50-day, starting to flatten out. Good news, still above the 200-day, and the slope is still up. We'll spend just a few seconds here. We've covered this in the past. How does the present day chart look? We do see an observable change that is different than the last time we saw it. During this entire advance here, this is 2013, price never closed below or on the blue line. We have that now. That's telling us that the trend here is weaker than it was here. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master Ccm Market Model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Ccm Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Ccm Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.